With such a wide range of products available, it's important to evaluate key features not just on financial metrics, but also on how well they align with participants' needs and expectations.
This is 401k Specialist Editor-in-Chief Brian Anderson, and this is the 401k Specialist Podcast. Today we're going to dive into the varying impacts that different retirement income strategies have on participant outcomes by checking out some key insights from a new white paper from the Allianz Life Insurance Company of North America. We're going to get to it right after this brief message.
At Allianz Life Insurance Company of North America, we prioritize a holistic approach to retirement planning and income generation. Our insights and tools enhance your understanding of income strategies tailored for employer-sponsored retirement plans. Learn more at www.allianzlife.com/DC Plan Research.
With longer lifespans and market uncertainties making retirement planning more complex than ever, Allianz Life's new report sheds light on how different annuity products can help retirees by providing reliable income throughout their retirement years. Joining us today to talk about measuring retirement income outcomes, I'm happy to be joined by Danielle Kelso, Senior Institutional Solutions Consultant with Allianz Life. We'll discuss the paper's key findings, the variety of annuity options analyzed, and how annuities could help improve participant outcomes. Welcome back to the 401k Specialist Podcast, Danielle.
Thanks. Happy to be back, Brian.
All right. Well, as I mentioned, Allianz recently published a white paper focused on measuring outcomes across various retirement income strategies. To start with, can you explain the primary goals of this paper and maybe highlight some of its most significant findings?
Definitely. I'm really excited to talk about our new white paper today. At Allianz, we saw a clear need to take a closer look at how different retirement income strategies perform. With increasing lifespans, economic uncertainty, and widespread anxiety among participants about how to withdraw money from their retirement accounts, there's a real need for solutions that provide stable, reliable income throughout retirement. A product such as an annuity that guarantees income for life offers a level of protection against market downturns and that can deliver payments on a regular schedule could be a powerful addition to a holistic retirement strategy. We know participants are struggling with retirement income planning. A recent survey from the Allianz Center for the Future of Retirement found that nearly 2 out of 3 participants feel overwhelmed when planning retirement income, and 77% expect their employer-sponsored plan to offer guidance on how much income they'll need in retirement. It's a difficult challenge because they don't know how long they'll live or how the markets will perform during their retirement years, yet they look to their plans for help. This is where we see a significant opportunity for annuities within defined contribution plans. So for this white paper, we set out to build a strong case for these products by demonstrating how they influence important participant outcomes, such as increasing the likelihood of meeting income goals, improving resilience to market volatility, and affecting the financial legacy participants can leave behind. In terms of findings, at a very high level, for most of the portfolios that included an allocation to an annuity product, there would have been notable improvements over the portfolio that did not have an annuity allocation. Notably, in worst-case scenarios where other portfolio assets might be depleted, having an annuity ensures a guaranteed lifetime income stream. This plays an important role in managing longevity risk, helping retirees avoid outliving their savings. While there was some variation in the other metrics we examined, this particular point is especially important to remember. Annuities are the only financial product within the defined contribution plans that can offer guaranteed retirement income.
Right. That's a big one. All right. The study examined 4 hypothetical portfolios. one without annuities, and 3 featuring different types of annuity products. Can you tell us a little bit more about the types of annuities that were analyzed and explain some of the key differences between them?
Yeah, definitely. So, as you mentioned, our analysis looked at 4 hypothetical portfolios, one without any annuities, and 3 that included different types of annuity products. We wanted to see how various annuities could impact participant outcomes, not just with our product, but also by comparing commonly available types in the market. The 3 annuities we analyzed were a hypothetical fixed annuity, a hypothetical variable annuity, and our own Allianz Lifetime Income Plus annuity, which is a fixed index annuity designed specifically for defined contribution plans. And just a quick note here, each hypothetical annuity product described is intended to serve as a representation of annuity offerings available in the defined contribution market. These hypothetical products don't correspond to any specific annuity offered by any particular provider, and the details provided shouldn't be construed as a definitive guide to any single annuity product. It's important when looking at these types of products for a plan to examine all the features and benefits of the specific product before making a decision. So, with that being said, there are some key differences between the fixed index, and variable annuities. Generally speaking, fixed annuities are more protection oriented. They guarantee lifetime income that won't be affected by a market downturn, and the value grows at a fixed interest rate over time. Usually, to start getting income, you'd need to annuitize, which means giving up access to the lump sum value of the annuity in exchange for regular annuity payments. Variable annuities lean more towards growth. You still get guaranteed lifetime income, but the annuity's value can go up or down based on how the underlying investments perform, and principal isn't protected from market losses, but the annuity's benefit base generally is. Variable annuities typically don't require annuitization and often offered what's called a guaranteed lifetime withdrawal benefit, or a GLWB. This lets you take income regularly but still access your money if you need it for emergencies. Then finally, there's our fixed index annuity, Allianz Lifetime Income Plus, which falls in between a fixed and variable annuity in that it offers protection from market downturns like the fixed annuity, but also lets the annuity contract value grow based on how a market index performs, similar to a variable annuity. This market growth is generally subject to a cap or other limiter. And like the variable annuity, you don't have to annuitize. There's that GLWB feature, which offers income flexibility.
Right. Okay. Well, before we dive in much further, I'm wondering, can you walk us briefly through the methodology that was used in the analysis to help us better understand the comparisons?
Yeah, so the hypothetical case studies in this paper were all conducted using the Allianz Portfolio Impact Report tool, or what we refer to as the PIR tool, which is used to model the probability of achieving different retirement goals. Its primary intention is to serve as a robust scenario analysis and decision support tool, not as an individualized financial planning software. So, by running 5,000 Monte Carlo simulations for hypothetical portfolios, the PIR tool enables us to assess how different portfolio compositions, including the addition of an annuity, may quantitatively improve the likelihood of portfolio success under a wide range of market conditions. A key strength of the tool lies in its flexibility. We can adjust capital market assumptions, product features, and participant-specific parameters to simulate different risks and market conditions. And the PIR tool was developed by Allianz Investment Management, which is a wholly owned subsidiary of Allianz Life Insurance Company of North America, and provides hedging and investment management services for the broader Allianz group. AIM US is a seasoned team of investment professionals managing $160 billion in assets, specializing in asset diversification, risk modeling, and real-time risk monitoring. I won't get into all of the product assumptions and hypothetical participant profiles here, but these details can all be found in the white paper. What's important is that by using the PIR tool, we're able to take a well-confounded approach to understanding how annuities can affect portfolio outcomes in a hypothetical but analytically rigorous context.
Interesting. All right. Now let's turn to the results. What did the research reveal about how each of these products performs within a defined contribution portfolio? Were there some notable differences in the outcomes?
Yeah, so focusing on the first case study in the white paper, we examine a participant who we'll call Dana, a hypothetical 55-year-old participant planning to retire at age 65. She earns $100,000 per year currently and contributes $12,000 to her 401k annually. So far, Dana has accumulated $500,000 in her 401k account, and she also does have $50,000 in outside assets. By her estimates, Dana will need to replace roughly 70% of her salary to meet living expenses and other needs once she stops working. She expects $30,000 annually from Social Security and $3,000 from her other assets, which means she needs her 401k to generate the remaining $36,000 per year. Our analysis shows that adding an annuity to Dana's portfolio could noticeably improve her chances of meeting that income goal. Specifically, by allocating a portion of her 401k to Allianz Lifetime Income Plus, Dana would have increased her likelihood of success of achieving her income goal by 11 percentage points compared to a portfolio without an annuity. The hypothetical fixed annuity would have provided a similar 10 percentage point increase in the likelihood of success. In contrast, the hypothetical variable annuity actually would have lowered her chances by about 5 percentage points relative to no annuity. We go into detail into why this may be in the case in the white paper, specifically considering how the 0% floor for the fixed index annuity and fixed rate of return of the fixed annuity act as safeguards against market downturns, which helps maintain the stability of funds and likelihood of meeting her annual income goal. In a shocked market scenario where there is a market shock at age 65, all three annuity products would show improvements compared to the portfolio without the annuity. And you can see details about these market shocks in the white paper. Another key metric we discussed is median legacy value, which is the amount a participant would be able to leave for their beneficiaries from their 401k assets upon death. The Allianz Lifetime Income Plus annuity would have showed the greatest impact with a 47% increase over the portfolio with no annuity allocation. Overall, while results vary depending on the product and metric considered, the consistent improvements across scenarios make a strong case for plan advisors, consultants, and plan sponsors to consider including annuities as part of retirement plan design. Just a portion of the portfolio allocated to the annuity can meaningfully increase income reliability and resiliency to risks.
All right. Sounds like Dana's got some decisions to make. The paper considers three different hypothetical participant profiles. How did these varying individual circumstances influence the results of the analysis?
Individual circumstances definitely do play a key role in retirement outcomes, as no two retirements are the same. To reflect this, the white paper uses three distinct hypothetical participants, each with different financial situations that help illustrate how annuities may impact outcomes under varying conditions. So our second hypothetical case study focuses on Henry, who is age 57 and earns less than Dana and has accumulated about $275,000 in his retirement plan, significantly less than Dana's $500,000 balance. Because a larger share of Henry's retirement income target must come from assets outside the annuity, the improvement from adding an annuity are more modest. Still, an allocation to Allianz Lifetime Income Plus would have raised his probability of success by 11 percentage points and would have increased his median legacy value by 36%, demonstrating the positive impact annuities can have regardless of the demographics of the participant. The third hypothetical participant, Jennifer, is closer to retirement at age 62, earns $175,000 annually, and holds substantially more assets, around $820,000 in her 401k and almost $982,000 in outside assets. Given her large outside assets, her income goal from the retirement plan itself is proportionally smaller. As a result, the presence of an annuity would significantly enhance her outcomes. For example, the Allianz Lifetime Income Plus annuity would increase her median legacy value by 89% compared to a portfolio without an annuity. This happens because her required withdrawals from the plan are relatively modest, which would allow the annuity to cover a larger portion of her income needs while leaving the remaining other portfolio assets to grow more freely. Ultimately, these different case studies show that individual circumstances, such as income, asset levels, and proximity to retirement, can affect how annuities influence retirement success. So, this is why personalization is an important factor when it comes to integrating annuities in a retirement plan.
Right. Okay. Now, besides the numbers, what other important factors should be considered when evaluating guaranteed lifetime income products like annuities for retirement plans?
Yeah, that's a really great question. When evaluating annuity products, it's important to look beyond the math and consider features that enhance usability and appeal for plan participants. For example, product flexibility, such as access to cash value for emergencies, or the ability to control the timing and amount of income payments, are highly attractive to plan participants. Research from the Allianz Center for the Future of Retirement highlights that about 9 in 10 participants value features like the flexibility to choose when and how to receive income in retirement, as well as the option to take full or partial withdrawals after income payments have started. These features address real-world needs by offering flexibility for life's what-ifs. Another key but sometimes overlooked factor is portability. Participants may change jobs or experience employer changes in record-keeping systems. So, the ability to maintain their annuity without disruption is really important. Many products currently on the market require a new contract and potentially altered guarantees or pricing when rolling over to an IRA. In contrast, solutions like Allianz Lifetime Income Plus provide an individual contract that keeps the same guarantees, benefits, and pricing intact, offering participants continuity of benefits. With such a wide range of products available, it's important to evaluate key features not just on financial metrics, but also on how well they align with participants' needs and expectations.
Definitely, definitely. Okay, now finally, to close it out, what would you say are some of the top takeaways for advisors and consultants who are learning about and assessing retirement income solutions? What do they need to keep in mind to best serve their clients?
Yeah, one important takeaway is that including annuities in retirement plans isn't just a nice to have. It can meaningfully improve participant outcomes by providing guaranteed lifetime income. This means you can offer plan sponsors a powerful way to enhance their plan offerings and add value for participants facing retirement income challenges. Many of the solutions designed for the defined contribution market require only a simple change to the plan lineup, allowing plan sponsors to expand their retirement plan offering without adding cost. For advisors, this represents a valuable opportunity to gain a competitive advantage by deepening their understanding of these solutions. A key step is diving into educational resources like the Allianz Center for the Future of Retirement's new white paper, which unpack how these solutions can impact participant outcomes. Understanding the data and implications will help you better understand these solutions and guide your clients.
Danielle, you've shared a lot of great information with us here today. I want to remind everyone that we have a link to the white paper we've been discussing on measuring retirement income outcomes on the homepage for this podcast on the 401k Specialist site, so you can check it out for yourself. Danielle Kelso, Senior Institutional Solutions Consultant with Allianz Life. Thanks for joining us today and covering this important and timely topic on the 401k Specialist podcast.
Thanks so much for having me, Brian.